Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We're talking, I'm speaking in 45 or 55 minutes. This is really a subject matter that really just called for 2 to 3 hours. And I'm trying to deliver it very straightforward so that you can take this information and maybe use it in the next day, week, month, for any kind of asset. It doesn't have to be FCG. It could be anything. Yes, Terry said there are entire books on this. There really are. You're right. So I'm taking a stab at this. Thanks, Terry. So looking at the price of 1922, if I wanted to capture, let's say I assume that, in this case, FCG, at trading in 1922, was not going to move for a whole month, which option should I sell? Which is the best one to sell? If we're going to just fast forward, thank you, Tina. Thank you, Yo. Exactly. So this one would be the best one to sell. However, what if we're very bearish, but we don't want to sell the underwire? Which call option would I sell? I'm bearish? Exactly. So this would be bearish. And if I'm slightly bearish, I might want to sell the 18 call. You guys are getting it. Excellent, 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 excellent. And if you want to moderate your trading results, you could actually go out to the 2-month option. I personally don't see a lot of value in selling the 21 call for a dime. Anybody want to take a stab at why I personally, this is just my personal view, I really wouldn't want to sell the 21 call for 10 cents. And Tina says that I don't even like selling the 20 call for 25 cents. I have a rule that the risk, I want to actually take a certain amount in, and there's no right amount. Maybe it's 40 cents, maybe it's 50 cents, but taking in 10 or even 25, 20 cents, I don't like just taking in such a low nominal amount. Very funny. Ice cream cones have risen in price, so couldn't you get one anymore for that price? I don't know. Good point. Maximum risk for a covered call is a debit. So let's say that I looked at that 19 call, the at the money. I buy the ETF at 1922. I sell the call for 65 cents. What I want to know is how much. What's my debit? Well, my debit is 1857. I just subtract 1922 less 65. The rate of return could be approximately 2% a month. So what's the attraction? And how did I figure out? Well, I got the standstill rate of return. I wanted to know is how much would I earn 43 cents over the 1857, or about 2.3%. So you're thinking, oh, that's not that much. But if I did it for 10, 11 times, that's pretty darn good. Now, the problem is that's a stretch, because there are going to be times that the asset might actually fall substantially, and I'm only getting a little bit of a hedge. So I need to keep that in mind. My risk is the 1857. I could earn 43 cents on that, and so that's what I need to really think about. So just putting that in this table, I buy it for 1922. Just to be fair, you got to think about what are the commissions on buying the ETF, what are the option commissions. So if I did this trade, I bought it for 1922, I'm going to sell it for 19. So essentially, my net investment, 1857, I'm going to earn 43 cents over the $18.57 investment, which is about 2.31%. Again, there's no right answer. A lot of times I'll get the question, what kind of rate of return should I be targeting? So if you were to annualize that, which I would not, urge you to do, because, again, 1 month doesn't mean you could do this 12 times, but if you did, you could earn about 25%, but you're taking considerable risk when you're earning 25%. Terry says it's better than money in the bank. Well, sometimes money in the bank is better than being in the covered call, especially if we're going to see the market fall considerably. It all comes down to, if I really don't have any fear below 1857, this might be a good investment. But if I think this asset's going to go to 15 or 16, it probably doesn't look that attractive. So it always comes down to your view of the world. Here we are looking at the ETF initial value in 1922, and what if it goes to 14? And this is what I learned the hard way being a market maker, is that what doesn't always, even though we think, oh, it's going to end up right here at 19, you know what? No, actually, it might go, it might go to 14. It might go there. Now, it also might go to 24. So that's the case. That's true. You can do that. But again, you're going to need to think about your profit and your loss, your ETF profit, your 19 call, and then you could do your whole trade there. Actually, I think the profit and loss at expiration is not correct. I think this is not right, because I don't know how I'm adding $1 to each one. That doesn't make sense, because essentially you're going to be capped out. If you're selling, all you can earn is that 43 cents. So it should be 43 cents. That's your maximum profit. I have to amend these slides. Should be 0.43 all the way through. That's the maximum you could earn. Can't earn any more if you sell the 19 call. So the call break-evens at expiration. So I can basically say the difference between my strike and my ETF, and I earn 43 cents. And I can figure that all out. I can do the 20 call and the 21, and I can earn greater amounts, but only because I'm actually taking more ETF price risk. That's what I'm doing there. And essentially my premium being so low on the 20 to 21 that I'm compensated, since I'm not taking such my premiums. I'm taking very little premiums, that I now get to be long the asset up to 21 or to 20. And I can look at the debit on the covered call, and then the premium plus the difference between the strike and the ETF. So again, I apologize. The profit or loss at expiration should be capped out at 43 cents. So I apologize on that one. Sorry. Option prices are based on probabilities. In reality, the perceived uncertainty, risk changes each day, and option premiums are based on this uncertainty. So we're going to get this volatility is going to be changing. Leverage is created by the strike price I select. In the money options offer the least leverage, followed by the at the money, and then the out of the money. They offer the most leverage. Leverage is a double-edged sword, great when you're right and terrible when you're wrong. How do I decide which, in fact, I think Tina is asking this question. How do I know if I'm getting a decent price for the call? Right? How do I know that? Well, assuming you're an option buyer, the most you can lose is the premium paid. Buyers prefer a big move, preferably in their desired direction. Assuming you're an option seller, the most you could earn is the premium received. So that's why I say that your payoff diagram is going to cap out. Oops, let me just do that again. So your payoff diagram does cap out at a certain price. Right? It has to. So if I sell the 19 call for 65 cents and I paid 19.22, I can only earn 43 cents on that trade. That's it. Now, I think the guy was saying, isn't it possible to earn more money? Yes, it is possible if I do what? Roll the option. If I roll the option, I can earn more. I mean, I could buy that option back and sell another option. Typically, selling the at-the-money option will yield the highest static rate of return. Additionally, selling out-of-the-money yields a higher if-call rate of return and a lower static return. Finally, in-the-money options, they yield the lowest rates of return with reduced ETF price risk. So the out-of-the-money options give you the greatest leverage. When does the strategy work and when doesn't it? Well, when will it work, guys? When will the strategy work? When is this going to work? Somebody type it in. Thank you, Tina. When it doesn't move. So if I'm selling a 19 call, right, and the asset's 1922, I want it to be 19 and a quarter, 1950, 1875. That works. If it goes up a lot more, I'm still going to earn the 43 cents, but there might have been a better way to trade it. And if it goes down a lot, I'm going to be substantially poorer. So that makes sense, I hope, for everyone. The perfect spot is going to be, I always say, the best spot for a seller is at the strike price that you sold. That's really what you want. Risk and reward are inherently linked. You can't get away from that. So if you're trying to earn rates of return that are very high, you're going to have to take more risk, and I can't really overstate that point. It's very important. Occasionally, markets are going to move in unexpected ways. We all should consider diversification and even sometimes hedging. Maybe if you had a covered call, you might, and again, it's a different topic for a different day, you might want to buy a put option to hedge yourself. We have to think about taking too little risk and taking too much risk. You have to balance that. That's very important. So to summarize what I spent the last 50 minutes on, covered call strategy consists of buying stock, an ETF, and simultaneously selling calls on a share-for-share basis. Selling calls against a stock that is already owned is known as covered writing. Buyers of options prefer limited risk. Sellers of options prefer option premiums. Remember, the payoff diagram is going to look, I'm not able to draw a straight line, I apologize, but the payoff diagram is going to look like this. If I sell the 19 call, remember, all I can make is the extrinsic premium. So in the case of this option, it was trading at 65 cents, and I bought the underlier at 1922. I could make 43 cents, right? Because I'm getting paid 65 cents, but I paid 1922, so I'm going to make 40-something cents on that. Because I'm going to sell that option, or I'm going to sell the underlier at 19 if it ends up above 19 or at 19. So the rights and obligations, the seller of a covered call has the obligation to sell stock at the strike price at any time if assigned until expiration, and in exchange for accepting the obligation, you receive the premium. What is your view on this asset? Well, you're going to be moderately bullish. Why do I say that? Remember this diagram, very important. Is this a bullish or bearish diagram? Is a moderately bullish diagram. If I'm very bullish, I'm going to cap out my gains, which isn't good, and I'm going to have substantial losses. But if the market is quiet, this might be the best place to be. So it's a forecast of a movement, but not that much movement. I'm going to target greater or increased rates of return, willing to tolerate greater underlying price risk. And remember, theoretically, the greater the perceived risk, the greater the reward. The next Meisinger session, I haven't put it up on the ISC site. It might be in a couple weeks. It might be April 5th. We'll be on protective puts, but I have to really put together a back spread. Protective puts and collars. And I hope you guys all hung around for this. So I had a great retention rate here. Most of you guys did stay for the whole hour. So I urge you to listen to this again. And please come back for the next ETF session. The next ETF session will be with Mark Sebastian on March 8th, Patrick Soresna on March 15th, and Pro Market Advisors on March 22nd. And Terry wants to see the back spread. I promise I'll do that one probably in May. Let me see if there are any questions. Song has a question. Could you please, where is that? Sorry. I'm going to try to get Song's question. Could you please explain the break-even on selling a deep in the money call and how to manage it? Sure. So let's go back. What's my break-even? I mean, I wouldn't even want to sell. Look at this 17 call. It was actually, at the point I looked at, it was actually priced a little bit under parity. So you wouldn't want to sell this option. Not at $2.15 because the underlier is trading at $19.22. So I wouldn't want to sell that. It just doesn't make any sense. But let's look at the 18 call. How much, son, how much can I, if I'm taking in a total of 18 plus $1.35, I'm taking in $19.35, and I paid $19.22. So on that trade, how much can I make? 0.13. So how much can I make on the 19 call? Well, if you look at that one, I'm actually going to sell it for 19 plus that 65, 1965 less the 1922 for 43 cents. So I get paid more to sell the at-the-money option. But I get a little more price risk if I sell the 18 option, and you could always roll it. All right, let's see. I hope I explained that to you. Jason has a question. It says, must the strike price be reached before an option is exercised? It's very rare that somebody would exercise an option if the underlier is not well above the strike price. So think about it. Why would you exercise a 19 call if the underlier is trading at 19? Because now you have to put up the $19. Instead of controlling it with 65 cents, now you have to put up $19 rather than the 65 cents. So the option, the underlier is going to have to be pretty deep in the money for you to exercise. At expiration, though, somebody might exercise it if it's a penny in the money. So at expiration, if it's a penny in the money, somebody would probably exercise it, but prior to expiration, it has to be very, very deep in the money. Well, let's see if we have any other questions. I'm getting a lot of great comments. Thank you. Thank you. Song says, I would like to sell some deep in the money for some downside protection. You might want to sell the deep in the money maybe 2, 3, 4 months out, Song. Gives you a little more premium. Okay? A little more extrinsic premium. All right, let's see if we see any other questions. I'm going to give everybody another moment or two for any other questions. I see a lot of thanks. I know we're all good, but if somebody wants to type another question in, please feel free to do it. Because that's why I'm here. I'm the Director of Education. My job is educating investors in the use of options, and we're focusing on ETFs currently. So please, if you have any other questions. Any other questions? Let me see. Tina says, can I answer? Oh, Tina says, when you go in the money, it turns the trade into a directional trade, doesn't it? Tina, it actually, if you go deep in the money or in the money, it becomes more of a bearish trade. You're right. So if you're in the money, you're basically saying that think in terms, and this is a metaphor, when you buy bonds, you're trying to earn very low rates of return, but your principal is protected a lot more so than another investment. So when I'm selling a deep in the money option, it's almost bond-like, that I get to earn a little premium, but my principal is protected down at a much lower level, and that's why. But it is directional, if you will. It's if you sell in the money options, more than likely you're going to get called away. So Tina, I hope I answered that one. How many ETFs are there? Joby, that's a great question I don't know the answer to, but the last time I checked, it was 1,100, which means it's probably 1,200 now. How many ETFs are there? And if oil price is going higher, which ETF to buy? Joby, if I knew which exact ETF to what to buy, well, I would probably be somewhere else. Because I don't think anybody can tell you the exact ETF to buy if oil's going higher. But there are a lot of oil ETFs, and again, I'm showing you a nat gas one, that if you have a view on nat gas, you might want to look at the FCG, but being quite honest, you should do your homework and look at all the products that are out there. Find one that is most suitable for you. So there are many, many out there. Look at the goals of the ETF. Therefore, you understand the risks that are in the ETF. Okay? All right, I'm going to give everybody another 30 seconds. Getting a lot of great thank yous. I appreciate it. All right, well, thank you. You guys hung around for that whole hour, or at least even more than an hour. Thank you so much, and please come back next week. Mark Sebastian will be with us, trading with or against the trend. Following week, Patrick Seresnis, spread trading strategies for trading your directional views using ETFs. So these are all focusing on ETFs, Pro Market Advisor, beyond buying call options using ETFs. So thank you so much on the behalf of the ISC. My name, of course, Steve Meisinger. Most of the time I'm the host, but today I was the presenter, and I really enjoyed presenting. I haven't done that in a while, so thanks again, and I look forward to you coming back next week with Mark Sebastian. Thanks so much. Have a great trading day tomorrow. On behalf of the ISC, Steve Meisinger wishing you a great day tomorrow. Bye.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.